what do you think, folks? You think things are getting better out there for the real estate market, particularly in the commercial real estate market? So I think it's time to have an update because things are evolving more and more quickly now, especially as the Fed's rate hikes have begun to really bite into that arena and create some real havoc. What that does, though, is create the next crisis. And keep in mind, there is always opportunity in crisis, as long as you are in the right place at the right time with the right asset. We're going to talk about this and a whole lot more coming up. I'm Lynette Zang, Chief Market Analyst here at ITM Trading, a full-service physical gold and silver dealer. But really, I've studied currencies and currency life cycles since 1987, and all I'm really talking about in all of these videos are repeatable patterns. And there's another pattern that absolutely repeats, and that's the wealth transfer pattern that I would like all of my viewers, and then some, really the whole public, to be in a position. Because for far too long, that wealth has transferred more and more to those top 1%. And I say, the only reason really is because they have assets that help them maintain their purchasing power. So let's just dig in and see what's happening in the commercial mortgage-backed security market. And that's CMBS, which of course we know the central bank, the Fed, has been buying and is now making an attempt to run off its balance sheet. But we've got approximately $1.5 trillion in commercial real estate debt that's coming due in the next 3 years, the majority of which was underwritten in a vastly different interest rate regime. Yeah, let's say the ZIRP, zero interest rate policy regime, to be recapitalized. These maturing loans require additional equity and lower debt because they have lost value. Remember, interest rates, principal value. As interest rates rise, the market value of the principal declines. If the market value of the principal declines, it means you can borrow less on the value of that property. So these firms that, as the reverse was happening, right? As the interest rates were going down and the market value of the principal was rising, what did these companies do? They borrowed more and more money against the same property. So now that it's reversing, you got a problem. However, like I said earlier, there are always opportunities in crisis. Those opportunities are not here yet, but it gives you an opportunity to get into position to take advantage of this. We're going to talk about a lot of that today. So what you're looking at here are commercial real estate loans at all commercial banks. Now, who are the commercial banks? Your JP Morgans, your Wells Fargos, your Bank of America, etc. The big guys, which is also who all the smaller community banks depend on for their funding. But you can see, the gray bars represent official recessions. Okay, for whatever that's worth. But anyway, official recessions. And the answer 100% of the time when we go into a recession, since money is created from debt in the current system, is to just create more debt. And more debt they certainly did, especially with zero interest rate policy. They grew it exponentially. Now, all of these mortgages that were taken out in that lower interest rate environment, this is what he's talking about, they all have to reset to in a higher interest rate environment. at the same time that the prices are declining, and also at the same time that credit conditions are tightening. This is frankly a tremendous problem with the property prices now declining so quickly because, hey, during the pandemic, we started this work from home thing and people are fighting going back to the office. So there's a lot less need. But falling valuations and rising rates makes it so much harder to roll over the loans. And then, of course, you have banks that are backing out of that area completely. Fifth Third Bank is just the latest one to back off in office lending. And at the same time, you can see the rising level of banks tightening on commercial real estate loans. Can you see the problem? And what I think is particularly interesting about this graph, again, remember those gray bar represents official recessions. And in all of these heights, so this is 2000, well, this is 2000, so this is like 90s, 2000, 2008, 2020, and look, those are all unofficial recessions, but where we are right now, no. And if you listen to the talking heads, they talk about all the time, well, maybe we won't get this recession, maybe it'll be a soft landing, maybe. Well, this is the end of a currency's life cycle. It is not going to be a soft landing by any stretch of the imagination. No soft landings. And it looks like the rats are leaving the ship. So it was heyday when they were making all of this money on all of these loans, but now that the tide has shifted, the banks and others are, and private lending as well, is backing off. Because what happens when they can't roll those loans over or they don't have a large enough capacity, right? What happens is that the quasi-owners, those that took the loans out, they default on the loan and they give it back to the bank. So here we have Brookefield, which is a very large commercial real estate developer. And this, by the way, was from April of this year. They default on a loan tied to 12 building office portfolio. That's going to have an impact on the banks that is sitting on all of this debt because how easy it is to unload it. And remember, I showed you, as the interest rates go up, the market value of that real estate goes down. And the problem is they when Brookefield took out the loans, the valuation was up here, right? Because the interest rates were so much lower, so it pushed the market valuations up. Now that interest rates are higher, the market valuations are there. So even if the banks are attempting to liquidate the property, they're underwater. So what are they going to do? This is a big problem for the banks, whether we see it or not, because they want us to think everything is hunky-dory with the banks. But we just saw several banks go out because of this issue that we're dealing with. Debt issue, having a lower valuation because of raised rates. This impacts the banks and the banks' valuations. And now, this is just recently, Brookefield is dealing with debt issues at 8 shopping malls. So you can see the problem that's evolving. And this isn't the first default for Brookefield, and they're talking about back in April. In February, it defaulted on loans totaling $784 million tied to 2 downtown Los Angeles office towers. Those defaults came weeks after Columbia Property Trust defaulted on a $1.78 billion loan secured by a 7-building office portfolio. So, and it's not just one entity. This we're going to see get more and more and more prevalent. But it just doesn't impact Brookefield. It impacts the REITs that you're holding. I'll get into that in a second. But all of those defaults came on loans that were packaged, which means turned into product and sold to you, as commercial mortgage-backed securities. In a report earlier this month, JP Morgan analysts estimated that nearly $39 billion of commercial mortgage-backed loans backed by office buildings would default, or roughly 21% of all commercial mortgage-backed securities office loans are set to default. And that's on the good side because they're not going to tell you the bad side. So I want you to actually stop and think about, it's kind of like, oh, we should have set up the dominoes. It's like a domino effect. So these developers default on these loans. That impacts the banks. It impacts REIT holders. It impacts everything throughout the entire global system, because this isn't just happening in the US, it's happening all over. And it does not say that we are going to have a soft landing. It says just the opposite. But they're not really talking about it too much. They're talking about it a little bit, but they aren't showing the dominoes that are likely to fall from this. This is probably the most important thing that I'm showing you today, because these are REITs, real estate investment trusts. And securitized means they took all of those loans and they put them in a pretty package, and then institutional investors put them in pension plans, put them in retirement plans, they're in mutual funds, they're all over the place. So I can't say whether or not you own some, but you might want to really find out. And if you have not done this already, click that Calendly link below. Get your ducks lined up. Get your strategy in place. You're going to take a look at how you're currently positioned. And it could very well be, if you haven't done this yet, to take a bit of a deep dive into that. And don't make assumptions, because that's not really going to serve you well. So you can see that the level of securitization on these assets, well, it dropped pretty substantially as people foreclosed, right? As they went away. But who did it really hurt? It hurts the investors. These are securitized. It hurts the investors. That's who it hurts. And you're looking at roughly $160 billion worth of REITs that have been turned in, which is where where JP Morgan got the $39 billion from, as far as 21%. Can you see that? There's $160 billion in securitized garbage out there. You better make sure you're not sitting on them. Or if you are, you better darn well make sure that this little portfolio diversifier diversifies you properly. Because Wall Street wants you to think you're diversified if you own stocks or if you own bonds. Hey, those are two different categories. No, they're not. They're all denominated in this, and they're all intangible. And if you don't hold it, you don't own it, regardless of what your perception is. In a court of law, that does not stand up. And we've been watching now for a while what's been happening in, say, San Francisco. Can we have that screen, please? Thank you. San Francisco dealt another blow as Westfield walks away from downtown mall properties. And this is in the heart of downtown, to be handed over to lenders. Now, the interesting thing about all of this is how hard it was to actually find out who the lenders are in any of these cases. That's held opaque because they don't want you to know that your bank is just another SVB waiting to implode. Yes, it is. Did they make it look like things are calm? Yes, that's their job. However, you want to know that this dynamite is in everybody's package. And I have a question from MK Meyer. How much gold is needed to protect or hedge a 401k and the gold equivalent in its value? It depends on how much you have in there, but it goes to that gold equivalent, and it's based upon the current fundamental value. Our consultants have that formula in front of them. So if you talk to them and say, okay, my 401k is 100,000, 500,000, 2 million, whatever that 401k is, they can calculate out for you how much gold you actually need to be properly diversified? It's a great question. I'm glad that you asked it. And yes, you're going to go to the current fundamental value so that when the value of all of what you're holding in the fiat money evaporates, you're still made whole. Okay, the mall is co-owned by Unibel, Rodamco, Westfield, and Brookefield Corp. Gee, didn't we just talk about them? Has $558 million in outstanding mortgage debt. Management will be turned over to a receiver. They're walking away. But the move comes a month after Nordstrom Inc. said it was closing its store at the site, citing a drop in customer traffic and changing dynamics of the city. The mall is in the heart of San Francisco's Union Square district, one of downtown's main shopping and tourist areas. But, you know, it's not just how you think this is going to impact the banks, but it's also how do you think that this is going to impact the city revenues, the revenues that they need to pay firefighters and police officers and teachers and all of the other people that have to do, and garbage collectors, etc. So can you see this domino effect that happens when this one piece doesn't hold up? And the reality is all of this was created by the money printing. You know, this problem was really created by Zerk. You know, the big experiment and the unintended consequences. Do they own any of it? No, but you should know the truth, because how many times can you be lied to when you do not know the truth? Every single time. So I'm showing you what the truth is. The writing is on the wall. Office lenders may have to go all out ahead of mass surrenders, because this is the last thing that they want, is to have all of this property turned over to the banks that lent them all of this money. So for the past few months, reality has been setting in for owners of U.S. office buildings. Many of them have debt coming due on buildings worth much less today than when their loans were originated. That value destruction has distressed asset buyers lining up to pounce. Okay, I've done studies on this, and maybe Randy is actually working everything today. Edgar is still here. But we want to put in the piece that I did on 25 ounces of gold buys a city block, buildings and all. So, and I did a whole piece, not just in Berlin, but in a whole bunch of different countries. That is the opportunity that presents, because quite frankly, this gold is being intentionally suppressed because they don't want you in gold. It's out of their purview once you buy gold. So you that hold it are buying an severely undervalued asset that is in a long-term positive trend. Regardless of what the spot market says, we know the physical market is making highs again. It's going up pretty substantially because demand has outpaced supply. On the spot market, which is what most people look at to get a valuation, no, they can create as much gold as they want to in that arena, but in the physical only market, that's where you can see the truth. So if you're sitting here and, you know, in Japan, the commercial real estate dropped 95%. So what do? Right now, you buy gold, and then you just sit and you wait, and you let this whole thing play out. We will see at the bottom a cup formation. We will see that formation occurring. When we see that, that's going to be the key to tell us that we are somewhere near the bottom. Because that is a very powerful, I've shown it to you a gazillion times, I'll show it to you a gazillion more. But that cup formation is telling you that the smart money is quietly accumulating. That's when you and I will convert some of this into some of that. And you'll have a big enough window to see what is most likely to evolve after that. Lenders are loath to take office properties back from borrowers in the current environment for the same reasons that borrowers want to give them up. Yes, because the reality is they're going to drop a whole lot more in value. And if they need to liquidate them, that means they're going to take huge losses. That means you're going to notice it. That means you're going to likely make different choices. It's all about educated choices, all about educated choices. They're trying everything they can to reach extension and modification agreements. Yep. But I really think finding a bottom, and I agree with them, I think finding a bottom is going to take a really long time. So there's your opportunity. You accumulate this now while it's undervalued. You let this real estate go down to an undervalued level. At this point, you got to understand the way when the public loses confidence, the way that they regain that, or they attempt to regain that confidence, takes a minute, but the way they attempt to regain that confidence is by revaluing this garbage that has no intrinsic value, has value in one place, with good money gold that is all intrinsic value because it's used in every sector of the global economy. So it's all intrinsic value because it has the most functionality. I mean, it really is that simple. It's not rocket science. If it's too complicated, for you to understand like a lot of this stuff is, you got to understand that they make it intentionally complex so that you just go, oh, well, they must understand it. I don't understand it. You need to be able to understand what money really is. They don't want you to understand it because they can take advantage of you when you don't understand. Don't be taken advantage of. Okay. And something, because we've been talking about commercial real estate, I thought this was really interesting and might be foretelling what's coming up or what's to come up in the residential real estate market. Starwood eyes sale of more than 2,000 rental homes, and they're seeking to sell those that they just acquired in 2021 at the height of the market. Right? I think this is really interesting. The Starwood REIT, Real Estate Investment Trust, with a net asset value of $12.8 billion and a portfolio concentrated in housing and industrial buildings, has faced higher redemptions in recent months. You vote with your wallet, you vote with your purse. Leading the firm to restrict how much money the trust returns at one time. In other words, you want your money back and they say, too bad, so sad. Who are you going to call? Nobody. They have every right to do it. Why? Because if you don't hold it, you don't own it. I hold it, I own it outright. No counterparty risk. This is all counterparty risk. Similar funds sold to affluent retail investors, such as Blackstone Real Estate Income Trust, have also limited redemptions. So what are you waiting for? It's easy. If you don't hold it, they can easily say no to you. And by the way, they are changing the money market rules so that you think of it like this is a savings account. It's not a savings account, it's a mutual fund. And if they want to limit redemptions or halt redemptions completely, they have the right to do it. It's in the contract that you agreed to when you bought this garbage. But my question really is, are they attempting to get ahead of the residential real estate price implosion? Because even though it's been coming down in some places, it's been actually going up in other places, or the speed that it's going up has slowed. So I'm wondering if they are trying to get out where it's still somewhere near a high before it goes to a low, which is when you're going to want to be getting in. There's the opportunity. And there are three pieces that go along with dynastic wealth, which may or may not be important to you. I can tell you it's important to me because I want to leave a legacy for my children. And it is real estate, truly rare collectibles, and gold. Now you can do all three with gold. So here's a gold mine. Now Newmont, which is I think the largest gold miner, especially after the most recent acquisition, well, they're having a challenge because striking Newmont miners are cashed up to extend Mexican stoppage. So they're coming together in community and they're saying no. Workers at Mexico's biggest gold mine have plenty of funds available to extend a strike as a dispute with owner Newmont enters its second week. About 2,000 unionized workers at the Penasquito, sorry if I butchered that, mine, downed tools last week over a dispute regarding a profit-sharing agreement and alleged contract breaches. The strike marks the third labor dispute since Newmont bought this mine from Goldcorp in 2019. Now, if there is a stoppage, if there's a strike, that means less gold is coming out, right? And gold itself, there is a finite amount, whether it's above ground or it's in the ground. We know how much there is, and there's a finite amount of it. This is one of the reasons that gold has always gone up in terms of the fiat money, right? Because there's an unlimited amount of this. They'll print it until nobody will accept it anymore. That's what they've always done way over 4,800 times. That's the answer, right? Just print more of this. But there's a finite amount of this, and it's severely undervalued. Going into this social, economic, and financial system reset, what do you want? You want something that they can willy-nilly at any moment devalue or even say, hey, this is no longer money, you can't use it anymore? Or do you want something that's been money for thousands of years that's used in every single sector of the global economy? This is what? Maybe a butter knife? This is a bazooka. I want a bazooka. And a secondary bazooka. So, we need to keep in mind what's really going on because it takes labor to pull gold and silver from the mine. It takes energy and it takes labor. That's one of the big reasons why gold became the primary currency metal, was because when we were on a gold standard, you're trading your labor for someone else's labor. Now you're trading your labor for something that's easily devalued, and moving into the future, if they have their way, and there's no guarantee, we vote with our purses, or in our wallets. What are you voting for? I'm voting for good money. If enough people vote for good money, they can't pull off the CBDC. Which then what are you working for? You're working for something that the central bank can control 24/7 at will.